You want to have complementary markets and complementary models too. We don't, even though the channel breakout approach is now the dominant model that we use in our set of proprietary models, we also incorporate other trend factors into what we do. There's three different areas. There's rate of change, which is absolute momentum, time series momentum, moving averages. They all fall into that category. There's market structure, which are chart patterns, things like Dow theory that look for market congruence and patterns. And then there are these breakouts, volatility and channel type.
Welcome to the Algorithmic Advantage. We're here to expand the toolkit of the quant trading community and introduce investors to the many advantages of systematic trading. Our goal is to educate and inspire as we embark on a captivating journey into the vast knowledge and experience of leading portfolio managers and other experts in the field. We hope you enjoy the show, and if you do, please subscribe, leave us a review, or even buy us a coffee via the link on the algorithmicadvantage.com. We really appreciate it.
Gary Antonacci, welcome back to the show. It's great to have you here again. How are you doing?
Thanks, Simon. It's good to be here.
Rich, good to see you, mate. How are you in Brizzy?
Yeah, very good. Looking forward to this talk by Gary, enlightening us on his latest research.
Yeah, Gary has been busy compiling more research, bringing in new models, new logic, new thinking, updates. So we thought it would be a great opportunity to get him back on and discuss some of that, see where his head's at and what he's been thinking. Gary, I thought it'd be good to start with this research paper that you did together with Carlo Zarattini. He's from Concretum Research, so I do follow him, familiar with his work a little bit. A Century of Profitable Industry Trends is the name of the paper. And doing a century of research is always a good foundation or a good validation of things that we're doing in the trend and momentum side of things. I like the basic introduction where we go back again and define cross-sectional momentum, time series momentum. If people want to get into that and understand Gary's dual momentum approach, simply go back to the prior podcast that we had with Gary. We went through all of that in quite some detail. And today it's going to be a good opportunity, I guess, to progress from that point forward and chat a little bit about this paper and Gary's new models. And Gary, just to kick off, I guess, with this paper, one of the initial questions is, you're doing 100 years of research on sectors, I guess, US equity sectors, which can be implemented with ETFs in a modern framework. But going back 100 years, there were no ETFs. So can you just remind me of how you gathered that data and what that looks like and how it approximates what somebody could trade with modern ETF?
Well, we went to the the French website, and they have industries, segmented out, various categories from a smaller number up to a larger number. So we picked a pretty large number so that we'd have enough separation there, enough different representation. And having 100 years of data to work with, like you say, is a wonderful thing.
Now, you did focus, or this paper, I guess, focuses very specifically on US sectors, right? Was there an interest on focusing more broadly from the outset, say international, or adding in commodities and other things like that? What was the reason behind focusing on US sectors in this paper?
Well, that's what's covered in the French database. So we just wanted something where we had a lot of different items, and here we have 100 of them. And there's differentiation because they represent different industries and industry groups. So that's as far as we could go with it and maintain the amount of data going back 100 years. Of course, you can always broaden that research later. That's usually what academics do. Once they find something works in one set of data, they'll go and look at other sets of data for replication and verification.
So you're essentially validating momentum and trend following factors, logic, if you like, in this paper. So can you talk us through the model roughly that you've applied here?
We applied two of the simplest and oldest trend following models out there, and those were channel breakout systems put together by Richard Donchian and Chester Keltner. So you see them probably in lots of different charting packages, the Keltner and Donchian channels. And they work on similar time frames. So we looked at basically when we break out through these channels that go back 20 days, then we take that as a signal for initiating trades. And then we wanted to give the trades some room so that we didn't have too much trading going on, and so that we could allow enough activity to happen without a tremendous amount of turnover. So we just very simply doubled the channel length in terms of the exits. So it's 20 days to enter a trade and a break of 40 days going the other direction to exit.
And I believe the entry is usually the first hit of either the Donchian channel or the Keltner channel. So whichever is hit first, so to speak, that would trigger an entry.
And the same on the exits too.
Yeah, same on the exits. And then you're applying this over those, is it 48 sectors?
Yes, it's 48 different
I think it was
industries.
And is there a rotational or a cross-sectional ranking factor in here as well? Are you just trading all of those 48 sectors simultaneously, or are you holding less than 48 positions and then rolling in and out?
It depends on how many are signaled. So if we're in let's say a bear market, we're not going to get all that many giving us signals. Whereas if we're in a really strong up market, we'll get quite a few. And then we have to do position sizing to take account of that. And we do that on a volatility basis.
Right, okay. So it's the volatility-based adjustment to the position sizing that determines the size of the positions rather than the number of positions. You're always open to jumping on all of those sectors if they're all trending at the same time.
That's correct. So in a way, it's adjusting to market dynamics, because we'll be more invested when the markets are strong and less invested when they're not. So in the first version of the paper, we didn't separate that out, but we added a section recently where we took out the effects and could see how much was due to the market influence and how much was due to the sector rotation part of it.
Just remind the listener, Gary, why the channel logic, like the Donchian, the Keltner, why these are useful in terms of a bit of a noise reduction process.
Well, markets tend to ebb and flow. They'll trend and they'll mean revert. So what you want is some continuation, and momentum is persistence in performance. So there's a number of different ways of determining that. Rate of change is one. That's typically what people look at in terms of time series momentum. But another way is to look at channel breakouts. New highs are another way of looking at it. So we figured this was a very simple way. If we're making a new high over the past 4 weeks, then that's an indication that there should be some continuation. That was our hypothesis. And these channel systems from Donchian and Keltner and Bollinger, they're very popular. So they've been around a while. People are familiar with them. And I don't think they'd be so popular if people didn't find some success with them.
They give the market some room to move and operate in that noise band before we say, right,
Yes.
Once it's a breakout above that, then now we're looking at something more significant than just the noise, so we're not trading as much
That's
noise.
correct. That's correct. I think Zweig has a system too, a 4-week type breakout that he applied in the stock market. So we're not inventing something new. We're just taking something that's established and that people have some confidence in, and we just extended it back 100 years.
Can you talk to us a little bit about that volatility-based position sizing that you implement? How does that work?
We calculate the volatility, and then we normalize with respect to a certain volatility level. Sometimes my memory is not real strong on that. It might be 10% or whatever that is. I don't keep track of the details in my head of all of that.
Mm-hmm. But there's essentially a daily rebalancing in this
Yes.
paper, I believe, isn't there?
Yeah.
So you're monitoring that volatility on a daily basis and adjusting the positions on a daily basis. So does that would increase the trade count quite a bit?
It does, and we in this later section of the paper we try to account for transaction costs.
So it's quite an absolute trend kind of approach, like including the use of stop losses, I believe. So you've got stops in there as well.
Yes, that's built into the way the system is put together. But the main component are the channels. You're getting in on a certain amount of momentum, and then you're getting out when that fades.
And I mean, at the end of the day, what are some of the conclusions here when we compare a basic strategy, trend following strategy across 48 sectors over 100 years, entering trades based on breakouts of channels, exiting based on breakdown of the channel, position sizing and balancing that portfolio to keep our volatility in check? How does that compare to a buy and hold of the S&P 500 over the past 100 years?
There's a dramatic improvement, of course, and otherwise we wouldn't have written the paper, I guess. So But we do account for transaction costs, and then we extend it to the ETF universe. We take the Spider ETF sectors, and it holds up well there as well.
So you do a lot of work on the ETFs, I guess. Can you talk to us a little bit about, the kind of due diligence you have to do in selecting ETFs, deciding whether to use the State Street sector ETFs or another mob's ETFs? What's some of the thinking that goes on there?
I actually spend a lot of time and energy on due diligence. There's so many ETFs out there and new ones coming all the time. So the first thing I look at is trading volume. Make sure that there's enough liquidity so that your trading costs aren't too bad. You have to also balance that out with the fact that ETFs have market makers who tend to maintain markets and keep spreads in line as long as they can do arbitrage with the baskets of what's in those ETFs. So in some ways, ETFs are better than stocks or closed-end funds because you have that ability to keep tighter spreads due to the market makers involved who maintain markets in these ETFs. But still, there's a lot of ETFs out there that have very little volume, and we try to avoid those. And then it's a question of just digging in, like you would do due diligence of anything, and seeing does their approach make sense? How does their performance compare to similar ETFs? What are the expenses? Look at a lot of different things like that. The main thing is, how does it fit into the portfolio of what we're already doing. And that's a very important part of what we do. My background is in portfolio management. So Ray Dalio once said, the holy grail of investing is finding good return streams that are not highly correlated. And that's what I try to do. The trading algorithms that we use work on pretty much everything. So we could be trading, everything in the whole world. And that's what a lot of these commodity trading advisors do. And one of the reasons I think their performance hasn't been as good as it might have been over the years. It was in the 80s, 70s, 80s, and 90s because you had a lot of premium flowing from hedgers to speculators. And after you had a lot of speculators enter those markets, then it became more difficult. But they still had a shotgun approach. And what we try to do is take a more nuanced approach and find things that markets and ETFs that go well together, that can minimize the overall portfolio volatility, and while retaining possibility of good returns.
Before we move on to then how you've applied some of this research in your own models and your new model updates, Rich, did you have anything that any thoughts triggered from reading the paper itself?
It was a great paper. I love looking at papers that go over 100 years of research, and I particularly liked your table where you went from 1924 up to 2024, and we looked at the sort of annual returns generated by your models. And interestingly, I did notice that there's not a consistent performance across the table from across the time series. There are certain periods which are magnificent performing periods, and other periods that are less notable in terms of their performance. But that brings me to a question, Gary. Firstly, it's a long-only model we're dealing with here. We're not dealing with short models as well, using the same basis. Is that
yes,
correct?
That's correct. There is a drift upwards of the market, so we want to have every advantage that we can. We did look at the possibility of hedging, and we might have left that out because basically what it does is it shows that there's really no benefit to hedging.
It's interesting there, Gary. I noticed that when you did actually look at the hedging component applied to your models, you did get a improved Sharpe, you did get a reduced drawdown, but the overall performance was lackluster. So whilst we might have had a smoother result, it certainly didn't add to the compounded returns over the process by hedging that component. Is that correct?
Yes, that's correct. And one of the takeaways I think people should take from something like this, and you mentioned that in a way too, what you just said, is that there are regime shifts over time. So you can go 15 or 20 years and have a certain type of regime, and then another 15 or 20 years and it could be different. So that's the danger of only taking a small amount of data and looking at it. When you have 100 years of data, then you can get more of a big picture of things, and that can help you have patience during times when you may not be performing up to the level that you hope to. Every type of approach is going to have periods of relative overperformance and underperformance versus benchmarks. So you have to have confidence in what you're doing. And to have that confidence, you have to be able to go back and do thorough and extensive research on lots of data.
And look, in relation to that, I'm just questioning your use of the volatility adjustment, basically keeping volatility constant on a daily basis, annual rebalancing, etc. Why did you do that? And did you look at models where you didn't volatility adjust and you took advantage of what I'd call the tail properties in particular clusters or particular regimes? But by volatility adjusting, you are basically normalizing the whole process I was just wondering why you approached it that way.
Well, it's kind of on a risk parity kind of a basis. Most academic papers, if you look at them, they volatility adjust just to put everything on more of an even keel. Otherwise,
Yeah.
you can have things that get skewed way out of proportion, and then you have the problem of is it really representative of what's going on, or is it just because you have a strange portfolio, so
Yeah.
so you want to try to normalize things as much as you can when you're doing research.
Okay, no, that's fair enough. Look, the last question I've got before you move on, I noticed in section 4.3, which was a particularly interesting session, which looked at what were the dominant contributing factors to overall profitability, and your conclusion was your reference to the word timing. So just to put that into context, you're talking about the use of these breakout models, Keltner and Donchian breakout, that restrict entries and exits to defined points in time. In other words, not trading within the noisy regimes and pushing your results out to the tails of the distribution. That was fascinating to me, and that's something that I'm certainly getting in my research, noticing that if you are more selective in not trading the noise or avoiding what I call the bulk of the distribution, and therefore focusing on the tail properties of the distribution, you're naturally benefiting from these extreme and sort of the more chaotic regions of the distribution in the tail regions. Is that what you're finding?
Yes, that section you referred to is something we added to the paper recently because we wanted to separate out the different influences, in terms of the results that we were getting. So we wanted to see, how much is due to the market, how much is due to the industries, and how much was due to the timing model. And we found that the timing model was the major determinant in terms of maximum Sharpe ratios.
Fascinating. Over to you, Simon.
Well, what I like about this, Gary, is that when we just look at, say, running a back test on an ETF, there is a somewhat limited history to go on as we compare it with, say, stocks. So you've been able to take a longer period of data to validate concepts, and then you can apply that to the ETF trading down the track, which is a great way to sort of get around the fact that the ETFs themselves don't have all of that historic data for analysis. So I guess bringing this together into how you've applied it in your updated models, what are the principles, what's the high level of what you've updated in your thinking or in your models to come up with your updated models?
Well, that's a good point about limited data for ETFs. So what we do is we try to get index data as much as we can, and that usually goes back further, sometimes quite a bit further. So that's one of the things we do. And the other thing is just cross-validation. If you get a model that works across the board on everything you look at, and you can change the parameters or whatever, and it holds up, you can have confidence in that even when you don't have a tremendous amount of data. And the other thing is, like I mentioned before, you want to have complementary markets and complementary models too. We don't, even though the channel breakout approach is now the dominant model that we use in our set of proprietary models, we also incorporate other trend factors into what we do. I mentioned that in my recent blog post that there's three different areas. There's rate of change, which is absolute momentum, time series momentum, moving averages. They all fall into that category. There's market structure, which are chart patterns, things like Dow theory that look for market congruence and patterns. And then there are these breakouts, volatility and channel type. So we'll have a combination of approaches as well as a combination of markets. And that gives us some confidence and some assurance that even if something isn't up to snuff, that we have other things that will give us the good return streams that we are seeking.
So there's those three broad kinds of trend following model types. I like that breakdown. And then the markets, in terms of the markets that you look at, how broadly do you apply this, or what kind of universe are you looking at? Are you focused on equities? Are you focused on US? How much does international come into it? And how much do you try to replicate, say, the futures CTA that's trading all sorts of commodities and currencies and all the rest of it, to bring all that in as well?
We have a minor allocation in that area, and in managed futures and commodities. That's a part of one of our models, and we use that. That model is kind of a backup. It kicks in when our single factor models are in a risk off position. Then it's a broader model that will look at three different ETFs in either an aggressive stock-oriented mode or a less aggressive bond-oriented mode. And then a managed future or commodities ETF can be one of those three, but it has to have absolute momentum going for it. People who just throw managed futures into a portfolio, I think they're creating a drag on their overall performance. Now, they'll smooth volatility some, and it may be worth it to them to do that, but I think there are better ways to do it, just more intelligently. You apply trend to the trends. So when it's going in the right direction, then you want some exposure. When it's not, then there are better places you can employ your capital. Now, gold is an area where we do make a significant allocation, again, when the trend is going in its favor. We find that that's an interesting market because it's different enough from everything else that we're doing that not only can we expect good returns, but we can keep the correlation down by using gold in our model with our other models. Otherwise, we have a fixed income model, we have a equities oriented model, a gold model, and we have one that's oriented towards digital assets like blockchain and Bitcoin.
Right, but there's not a model or a strategy that's dedicated to trading, as wide a possible universe across all of these different industries, sectors, commodities, currencies.
Yeah, we have that
with as many ETFs as you can find.
We have two models that do that. There are older models. One is enhanced global balance momentum. That's using methodology like in my book. It's pure dual momentum, and that looks at a broad mix of stocks, bonds, and other things. The other is advanced global equity momentum. That's the one I just described, where we have an aggressive and a less aggressive module, and it's in three different ETFs that can have different areas of the stock market or different areas of the bond market, maybe some managed futures and commodities. Some market structure is employed there, and that will use daily data as well as monthly data. Our older model only uses monthly data. So we do have that, but we'd like to be in equities as much as possible because historically that's where the highest risk premium has been, and that's where investors tend to be the most comfortable. They're familiar with it, whereas they're not so familiar with some of these other things.
Okay. So where does that lead us in terms of some of your, model updates? What are the key points there?
What do you mean by updates?
So if I understand correctly, you've got a bit of a, some next generation dual momentum models, if you like, where you've updated your AGEM model or, started to bring maybe some of this channel breakout stuff into your models. Is that correct, or am I on the wrong track?
Yes, no, that's correct. With AGEM, that's That's using dual momentum along with some market structure. And the main thing going on there is to upgrade the portfolio. So I'm always keeping track of ETFs, and I'll upgrade the portfolio universe of ETFs. That's all that happens there. The other are our channel breakout models. Those are the dedicated single asset models that are layered. They'll go from one asset to another. And then if they're out of all those, then they'll go to AGEM as their ultimate backup. And AGEM could be in T-bills entirely, if that's what seems to be the best place to be. So that's been our evolution of the models. It's going from monthly, like most people have, with a broad-based monthly approach, to incorporating daily data and some market structure, to the newer models, which are primarily channel breakout, focused on single assets that can rotate using relative strength into closely related assets, but not too closely related, before they go into a risk-off position.
How many single assets are we talking about that you'd be running models on?
We have one for fixed income, which is high yield munis and non-munis. We have a gold one. We have one for 2x leveraged Qs. And then we have one for digital assets.
And do you have a US sector-based specific model that's sort of similar to what you describe in the paper?
We tend to not go into sectors too much because the industry risk, we prefer to have as little idiosyncratic risk as possible in our models, so we try to stay as broad-based as we can. I do have a mean reversion model. It's not a public model, but it goes into sectors, and it's got about 80 different ETFs and a dozen or so mega cap stocks, and it's just short-term mean reversion. We do incorporate mean reversion into some of our single asset models as well, where it's suitable. Some markets are more suited to that, where the markets tend to overextend and then pull back. So one of the things we like to do, which others don't do, is we try to suit the model to the asset. A lot of people just have a shotgun approach. A lot of CTAs do that. They just take a model and they apply it to the whole world, like kitchen sink, and see what sticks to the wall when you throw it there, or what floats to the top in the sink. But you can end up with mediocre returns that way. We find that certain markets have certain characteristics. So we'll dig in and we'll analyze what those characteristics are and try to find an appropriate solution with the models that we have to work with.
Now, of course, how far do we take that, Gary? Because at some level, obviously, it's a good indication of robustness if we've got a strategy that can be applied over different markets. If we take it too far, where we are creating strategies for each, like, let's take an extreme example of creating strategies for individual stocks, we could very quickly start fitting to the noise. So what's the balance there? How do you think about, what's the right level of attention to pay to a particular market or asset to say, these are genuine, logical, idiosyncratic features of this particular market, and therefore I'm licensed to change my model to fit that, versus, well, maybe I'm overfitting and something would be more robust if it did trade across different markets. Like, how do you balance that thinking?
Well, we try to be as broad as we can, but for single assets, what we're looking at, like Dalio says, you want good return streams that are not highly correlated. So we're looking at correlation to a great extent, and that's more our selection criteria than how good the models are. I have, like with the channel breakout model type that we use, it works with all kinds of things, and I get really good results all over the place, but I just found certain areas fit well together, and that's how we go about determining what we do. We don't customize the model to the market, at a fine tuning level, that would be overfitting. We take the same model basically, and we just see what markets can we use that fit well together into our portfolio. The same thing like with AGM, we're using basically the same model, but we'll have 20 different assets that we could apply it to, 20, that are all that fit together nicely. 10 in the aggressive side and 10 in the not aggressive side. So that's how we do that.
Let's drill into the mean reversion stuff just to get that over and done with. And before we lose Rich.
You've already lost me.
And one of the reasons why I think it's interesting, though, Rich, is just because you've mentioned there, Gary, selecting 80 ETFs. So I think this is what I was hunting for. Like, I want to know about selecting a universe of 80 ETFs out of the many ETFs that are out there. Perhaps somewhat selfishly, because I'm engaged in this exercise myself at the moment, also from a trend following point of view, thinking about how one might execute trend following models in ETFs rather than futures, for example. But generally speaking, we're looking at a broad base of ETFs that are out there. There's a huge selection to choose from. If you want to bring it down to a meaningful selection of 80 for a particular model or a particular trading strategy. You've mentioned previously there's some due diligence to be done, but just at a sort of a sector level, are you trying to find 80 ETFs that are as non-correlated as possible, or that represent a mix of different sectors and global regions and things like that?
Yeah.
How do you come up with an 80 universe of ETFs?
We have a lot of variety in that universe. U.S., non-U.S., all different kinds of sectors, different countries, and so forth. I'll tell you what we look at there. Besides just having the diversity, we look at how do these markets, these ETFs, operate in terms of volatility, because volatility is made up of two parts. There's a continuous process and there's a jump process. And we don't like surprises. We don't like jump processes. Well, like in the mega cap stocks I use, basically I'm picking the largest cap stocks I can find because they're followed widely by analysts. They're not going to be a lot of surprises. You're not going to have takeovers, happening. So it's a matter of engaging your thought process and not just looking at data. And that's what we try to do. I can't go into a lot of detail, on exactly what we do, but that gives you an idea that it's not just looking at numbers. You have to actually get into what's going on with each ETF and try to understand how it responds to market forces. And sometimes we're wrong, and then we have to upgrade our portfolio.
And the just last question, I guess, on the mean reversion side. So these mean reversion models, are they fairly standard kind of short term, holding for a couple of days, buying extreme, overbought, oversold? Is it long and short?
Yes, it's long and short. On the single asset models, we don't go short. What we'll do is, let's say we're in QLD, and we're out of it. We're into the HM ETFs, and QLD gets hammered, which happens once in a while. Well, we'll get a mean reversion signal saying go back in, for 1 to 3 days or whatever. So we'll go in and we'll do that, and then that's incorporated into those models. Now, I have a separate program, like I mentioned, which uses 80 different ETFs and a dozen mega cap stocks. That I don't provide to the public. I used to give out the signals to my licensees, but they would get frustrated because you're basically going against the news, going against market action, and most people can't handle that psychologically. So I do it, and one of my advisors I work with that I license to, he does it for his personal account as well. At some point, there'll be a hedge fund that will use that along with our other models.
And how do you manage some of the negative skew risk associated with mean reversion? Are you worried about those black swan events? How much damage can they do to that kind of strategy, and what some of the thinking toward avoiding that?
Well, we've been doing it 5 years. I haven't had a problem yet because we will exit. We don't just stubbornly stay in a position. If it doesn't respond within a few days, we'll be out, and we'll take our loss. It doesn't happen very often, but it does happen sometimes. But I'll tell you one thing that's interesting is that when we get a lot of signals, or when we get multiple days of signals, those are the best trades, because the markets just get even more overdone, and then there's more likelihood of a snapback.
You obviously have sort of a maximum number of positions in there, like you're trading ETFs, 12 stocks, but on any given day you can only take so many positions, right?
Yeah, well, let me just say that mean reversion is not a big part of what we do. It's something that adds a little bit. It helps in terms of adding a little profitability, and also provides some hedge to what we're doing, because if the markets are going up strongly and we're going short, like we went short Berkshire Hathaway a couple of days ago, and now taking our profits. I mean, that's kind of hedges us when the markets go the other way. So it serves a dual purpose.
Absolutely, but I'm always going to ask about it, because I do actually like having an allocation to mean reversion myself. So good to know. So with your current and newer models, Gary, just remind me, to what extent you apply. Now I know it's tricky because you've got so many different models, but to what extent do you apply the relative or cross-sectional momentum versus the absolute? Like, what's the overriding principle there? Is it we'll only be in if there's absolute trend, and then once we're in, we can allocate to the most, the strongest trend? Is it that simple? Or
well, there's two different ways that we do it. The first, like you're describing, is the original way, which is in my book and in my older models, where you look to see that something has a positive trend, and then once it has a positive trend, let's say in equities, then you look to see what type of equity has the best relative strength, and that's where you want to be positioned. Now, the newer way, I use both, is a little more subtle, and that's in our single asset models. For instance, with our blockchain model, it's a blockchain and Bitcoin. If we're not in that model, it'll look to our gold model as an alternative, because they both serve as stores of value, as alternatives, and we'll see if the trend is positive there. And if so, then we'll just move into whatever position our gold model is in. And then the gold model, if that's not positive, it goes into our AGAM, our broader based model that can be in cash or any other things using dual momentum. So in that sense, we have relative strength working for us, even within our single asset models. And we do the same thing like in our high yield bond market model. We're in high yield munis, and then if the trend there changes, we'll go into short term non-high yield munis, and then if the trend there changes, we'll go into cash equivalents. So we have a layering going on in these models, which has worked out really well for us. Yeah,
it's kind of models within models, isn't it? Yeah. I love that capital efficiency. So it's like, let's say you've developed 3 different models, and rather than trade them in parallel, correct me if I'm wrong, but there's a rotational approach to the models themselves, so that if capital is not being effectively deployed in one, then let's take that capital and move it somewhere else rather than let it sit in cash. We'll move it to the thing that's working. So there's a second layer of logic applied on top of the models that will move money between models.
That's correct. A lot of people, they'll have a model, and if you're not risk on, you just go into cash. Well, that's not a very efficient way of employing your capital. So we have alternatives we can go in. We have separate models. We always run separate models, but then each of those separate models has alternatives it can go into. It's not switching between the models so much. It's we have the models. We run 4 models all the time, and then within those models we can switch to other models. So it's not like we will disregard a model and go into another one. So I don't. When you say switching, I don't want people to think that we just run away from a model. It's just that we incorporate one model into another, and sometimes we'll incorporate a different asset into that model rather than a different model into it. So you might want to make that clear.
Yes. So yeah, you've got. It's like you've got these 2 layers, and they're both really important. You've got a layer where you build up, say, a particular strategy, and your strategies are related. So there's an opportunity to use them in a combined method, so that at any given point in time you might rotate capital from strategy A to strategy B, and then now that works as a combination strategy or a meta strategy, if you like. If we look at it as a meta strategy between gold, Bitcoin, and so on, then I get that you can rotate between them. I'm wondering if you've got strategies that are trading like these sector strategies, 48 sectors, but you're choosing the top 10 strongest sectors.
That happens in our AGEM model. We'll be in 3 ETFs, either in the aggressive module or the non-aggressive module, and I can have a dozen or more ETFs in each of those universes, and then I'll use relative strength to tell which of those 3 that I pick and choose. The same with our EGBM, our old model. It uses both relative strength and absolute.
When you're looking at your trend-based entries and exits, if you're not using Keltner channels and Donchian bands like in the paper that you've published, but you're using something similar, are you also applying that band-based idea where you're trying to avoid the noise and get in above and below the noise level?
Of course, yes. That's the whole reason we use a channel breakout approach.
Yeah, but it's just your proprietary channel, if you like.
That's right. Well, there's one other thing going on that's interesting too that I wanted to mention, and it's interesting that Cliff Asness just came out with a paper today reinforcing exactly what we've been doing and saying, is that when you have multiple models in a portfolio setting, you can have riskier models as part of it. It's Nassim Taleb's idea of barbell approach, and you don't have to be afraid of some of the riskier assets if you have risk control through your models and you have good portfolio diversification with some expected lower correlations there. So,
can you just define that for our listeners? We've thrown that term around before. This barbell approach. Can you just break that down for us?
That's where you have higher and lower risk or volatility assets combined together in such a way that you can boost up your overall portfolio return and still keep your variance at an acceptable level, because you're balancing out the risk by having lower vol type strategies and assets as part of your portfolio. You also gain some rebalancing profits there too, because the higher vol ones will usually tend to go up more, and then you pull profits out and allocate them over the other way, and vice versa. When they're down, you're replenishing them. So you're buying low and selling high, which is what you like to do, as opposed to momentum where you're buying high and selling higher, hopefully. So it's another way of gaining a little bit of diversification in a sensible way that gives you a balance to your portfolio.
Rich, you've been very quiet.
I'd like to ask a few questions here. So, mean reversion, Gary, the question arises now. We've seen a lot of these studies of 100 years of trend following performance. We've seen the Grayson and Kaminsky work. We've seen your work. We've seen numerous studies now, which is legitimizing the universal properties of trend. Yeah. Has such studies been done for mean reversion?
Yes.
For 100 years?
Well, not for 100 years, but there are studies. I cite Lesmond as probably the oldest one, study of mean reversion. I just came across 2 other studies that I'm going to add to my fact sheets. It's fine. It's hard to go back 100 years, to find the daily data to work with. But these are different studies looking at things differently, and they come to the same conclusions. So that counts for something.
How does it stack up? What's the conclusions found with those mean reversion studies? Is it as consistent as trend?
They're complementary to trend, and that they offer abnormal profits opportunities. It shouldn't be.
So I assume what we're dealing with is that there are 2 broad universal features found in liquid markets looking at price data, the propensity for markets to trend, as well as the propensity for markets to mean revert.
Yes.
And really, when you think about it, that they've got to mean revert to trend, if you know what I mean.
Well, it kind of makes sense, doesn't it? Because
it does.
The way momentum works from a behavioral point of view is that there's inertia and underreaction initially, and then there's a catch-up effect, the bandwagon effect, herding, and so forth. And then there's overextension. So it's psychological. There's a speculative basis to a lot of things. And that's what I was saying about managed futures, is that the reason it doesn't work all the time anymore is because you don't have that excess speculative part of some of those markets. But in stocks and some other things you do. So the markets get ahead of themselves, and it's natural that they would pull back. And that's what mean reversion does. But there's 2 types of mean reversion. One is on a long-term basis of 3 to 5 years. Studies have shown that there's some mean reversion there. And then the other is on a shorter-term basis of a week or less. And that's how specialists on the exchanges, when they used to exist, that's how they made a living. They were fading the customer order flow that tended to, they would just take the opposite sides especially when markets would go to extremes.
Sure. Look, another question, Gary, is that we're continually referring to these 100-year studies as this persistent anomaly. And I'm just wondering why are we calling it a persistent anomaly when it is so persistent? And the second thing is, why are we always reverting to the equilibrium-based models of Farmer and French and efficient markets hypothesis as the basis, and then calling these things anomalies? Is it time to move on with a better theoretical model of how these markets behave?
Yes, but good luck with that. The problem is people tend to pay a lot of attention to academics, and some of it is worth paying attention to. I mean, markets are, for the most part, efficient, but they're not perfectly efficient. The mistake that academics made was to say that they were, strong form efficient, always that way, which is not true. And there have been other instances like that too. So people just, they give a lot of respect to people in the academic side of things. And sometimes it's warranted, and sometimes you have to go beyond that.
It's interesting, Gary, when we're talking about your paper, which you've recently done, where we're looking at the timing or using the breakout models to push ourselves towards the tails of the distribution. Yeah, interestingly, what you're doing there is you are reducing your sample set to be more applicable to tail properties of the distribution. But then I suppose if you're doing a mean reversion model, you'd be wanting to exclude the tail properties and focus on the bulk of the distribution to come around the convergent mean of the distribution. So, we're seeing the tail properties, we're seeing the mean reversion properties there. So we're seeing sort of mean reversion and trend and their overall universal properties found in the markets.
Well, it's not that different. You're just dealing a different time frame. So mean reversion, you're dealing with the tails of the distribution. You're just looking for it to go, back to where it came from. And then with trend, you're looking at a different, part of it, a continuation. And it's because you're dealing in different time frames that you can do that.
Yeah. Look, just another question. You both raised this capital efficiency notion and having multiple different models and how you're viewing this as the ideal scenario. I'd just like to question that, in that the assumption there, the implicit assumption there, is that all of your models have equivalent strength or equivalent performance. But is that necessarily the case? Are we making an assumption there? If we're looking at the performance of different models, if they were not equivalent in performance, then you'd say to yourself, well, why would I be wanting to allocate a portion of my finite capital to a less productive or efficient model? Isn't it better to focus your attention on the more effective or the better performing models, as opposed to a process of diluting returns or filling the potholes of your models by broadening it across different types of model if they're not all equivalent?
Can I just say at the outset, I think the first point is to be really, brutally logical, Rich. I think the first step is, the reason why I can say that is, if you've already a priori made a decision, say, to allocate a certain model to cash at a certain time, so that's already part of your equation, then once that money is in cash, you want it to earn the highest interest rate possible. So if you've got an option between 3 and 5%, you'll choose the 5 on your cash. So at one level, it's just an absolute truth that you want your capital to be working as efficiently as possible. The next step might be, well, I've got money in cash. I don't want to leave it in the bank. I want to put it somewhere else. So you could build it up step by step from there to a point where you might then make a decision to allocate it to another model. That would be my thinking, Gary.
Well, Rich raises a very interesting question. And I think Warren Buffett would agree with you, because he says diversification is for those who don't know what they're doing. And I think he meant over diversification. But the problem is, who's got a crystal ball? Who can really tell what the future is going to be like? All you have to work on is past data and whatever logic you can apply to what you think might happen in the future. So on that base, let's say you had total uncertainty, you would just allocate evenly across to everything. Okay, so the answer is somewhere in between. Having perfect knowledge and having no knowledge at all. So what you need to do then is look not just at expected return, but you have to look at the volatility, you have to look at correlation, and you have to kind of balance it. And that's as much of an art as a science. We try to do that. Like our digital asset one has by far a really high return, but it also has a high volatility. And our fixed income one has very low volatility and the lowest return, but we actually put more capital there, on kind of a risk parity basis, not total risk parity, but just to keep things in balance. So it's a balancing act, I would say.
Gary, I've got to ask you, how's your book coming along, and when's it coming out? Your book's going to be on trend following, I believe.
It will be, except I'm going to broaden it. I put a blog post up mentioning trend following, and I had a whole bunch of people who unsubscribed from my website. They didn't like that term. I guess there's so much bias against it. But the book will be about first principles of investing, and trend following is an important part of that. But there's others too, like the portfolio side, as I mentioned, and a few other things. The layering has something to do with that, and being able to use riskier assets within a portfolio context. So it's going to cover a lot of ground, not just trend following. But I think everybody should take a look at trend following. Maybe if you called it momentum, you'd have a friendlier attitude towards it, because that's more acceptable these days. But trend is broader. Momentum is just a subset of trend. It just looks at it in a certain way, but trend can have a lot more ways of doing things, and I think it's more interesting because you can combine different ways together. Then you're not just stuck with rate of change and relative strength. But to answer your question, I'm still in the early stages of working on the book. It'll be sometime next year that it's out. I have 2 publishers after me to get it done, but I'm in no hurry.
It's quite painful getting a book done, but
it's a lot of work. It's a lot of work doing a book.
Rich, did you have anything further to drill into?
No, all good, Simon. And thank you, Gary. This is wonderful again. And it's great to be updated with how you're going with your progress, with your research. And it was a fantastic read. And,
thank you.
Yeah, I hope all our viewers have a chance to really go through it in detail.
Well, you'll put links on, won't you, to
definitely,
of course.
I mean, I really enjoy talking to you guys, because you actually ask the best questions of anyone. You understand Gary. This stuff, and some people don't. They just ask me how I grew up and things like that. So I appreciate it.
I'm looking forward to the time, Gary, where we all sort of get together over a large dinner session over a big table, and we'll have the most amazing debates I could imagine.
Well, I have 2 or 3 licensees in Australia, so maybe I'll end up down there sometime.
Oh, do?
Yeah, that'd
say
be good.
G'day.
Yeah. It's interesting too that a lot of my licensees are outside the U.S. I think people outside the U.S. tend to be more receptive to unusual ideas or new ideas, or they're just smarter. I don't know, but
I don't know about that.
No comment. No comment. Is there anything else, Gary, that you wanted to sort of highlight out of the research or out of your updated models that we've missed?
No, one thing I'd say, I think it's important for people to do some homework, because a lot of people just follow the crowd. They just accept what other people are doing or what other people say. And the information's out there, but you have to put forth a little effort. Like if you go to a research paper, you don't have to dig into all the mathematics, but if you read the abstract, you read the conclusion, you look at the charts and tables, you can usually get an idea what's going on. And I put out research links on all my fact sheets, in my book, on all my communications. I encourage people to learn as much as they can, because that gives them more confidence in what we're doing, and helps them to better understand why they need to be doing something a little different than everybody else.
Well, I really like this paper, Gary, that you and Carlo have put together. Maybe we'll get Carlo on the show at some point as well. It's simple enough. It's easy for people to follow along, for anyone to follow along. And it's just a really nice addition to the long-term research stack, looking at 100 years across sectors, and I just like applying those channel breakout and breakdown approaches over 100 years. And then you've got, just some different ways of constructing the portfolio, whether it's equal weighted, and then you've got some, then you add the timing, and then you add the volatility-based position sizing, and you show the different return parameters for each of those as they break down. I think it gives us a lot of confidence in the trend following logic, and it just layers in nicely to the other long-term studies. So I do think it's a must-read for
Thank you.
for all the traders out there.
Thank you, and feel free to to edit to your heart's content. There may be things that you don't think should go out there or whatever. So I'm fine with whatever you want to do.
We'll keep the secret sauce stuff for ourselves, Gary. Don't worry.
Okay. I'm not too worried about that because somebody said if they published their rules in the newspaper, most people wouldn't follow them anyway.
Yeah, that's right.
Maybe one question, Gary, that I'll chop in there. So you've got a number of different models. When you have these licensees that are utilising your models, are they constructing their own portfolio? Or would you have a strong recommendation that portfolio should consist of, say, an equal weighting to all of your strategies?
I'm not an advisor, so I don't advise people on what they should do allocation-wise.
Sure.
I license to advisors who do that with their clients, and then to sophisticated investors who kind of know what they want to do. But in my fact sheets, I do put sample allocations, so people can see how they fit together, the different models, and they can just decide what suits their risk preferences the best.
Of course, understood.
If people ask me, how I allocate, I'll tell them, because I have...
How do you allocate?
I have over 95% of my assets in my own models. So I
yes. Okay. So what's your breakdown? Do you allocate to all your models, and is it on a fairly equal basis, or?
I have twice as much in the fixed income model as I do in the other three single asset models, and then AGEM I don't have to allocate to because that's the backup for each of these models, so it's automatically included. That's basically it. I keep it simple. And the reason for that is on QBAT, which is the stock market model, I'm in a 2X ETF. So you could say I have 20% there. You can say that's equivalent to having 40%. And then in the bond one, I do have 40%. And because the crypto one can go into gold, that ends up can be 40% at times. And then crypto will never go above 20 because of its volatility. So there's some method to my madness here.
Well, I think that's another thing that traders can really take away from your approach here is this interesting meta-strategy approach where you've got a couple of models working, and then you've got that AGEM model being where capital gets deployed to when it's rotated out of the other models. So just for traders to think about that meta-strategy approach, that's important in my trading as well, thinking about how all of our models are going to fit together, whether we want to have a specific hedge model or a specific model to allocate to when these models are in an unfavorable regime, or whether we want to run all of our models all the time in parallel. But just thinking about those things, I think, is really valuable. So that's a really important concept that you bring to the table here.
And what's interesting too is the markets always are interesting and always can provide some opportunity. I'm looking at a couple areas right now that might get incorporated into what we do. One has to do with what we talked about earlier about volatility. And then Carlo and I are looking at a mean reversion approach that might end up being a model. We'll see how it goes.
Mm-hmm. Well, happy to collaborate on mean reversion work with you and Carlo. Just let me know.
Okay. All right.
Gary, thanks very much once again. We really appreciate it. Good to hear what you're up to. Good to get an update and keep in touch and keep up the good work.
Thank you. You too.
Thanks,
You too.
Gary.
I enjoy your podcast. You pick good people to have on there.
Awesome. We do indeed. Thanks, Gary.
I should remind you that the conversations on this show are informal and for entertainment purposes only. Certainly any general advice you may hear is obviously not specific to your needs, goals, or objectives. So nothing discussed on the show should be considered as investment advice. If you want that, you'll need to actually do your own research and speak with your financial advisor. Remember, trading can be extremely risky and past performance is not necessarily indicative of future returns. If you enjoyed the show, please subscribe or leave us a review, and if you have any questions or feedback, we'd love to hear from you. Bye for now.